In this video, we're going to talk about how to identify real liquidity like a professional trader. Not the fake levels, not the stuff everyone talks about, but the liquidity that actually moves the market. If you want to stop guessing, stop chasing price, and start understanding why price moves the way it does, you're in the right place. And before we start, if you want to become a better trader every day, don't forget to like this video and subscribe to the channel. Let's get into it. Liquidity is the most important factor in the Forex market, and here's something most traders get wrong. Many traders think they understand liquidity, but in reality, they don't, because this market is not driven by supply and demand. It is driven by liquidity. What is liquidity, really? Liquidity simply means where the money is, where large orders exist, where big players can enter and exit the market. Banks, institutions, and smart money, they don't chase price. They move price to areas where liquidity exists. That's why this market works the way it does. The truth about price movement: price doesn't move randomly, price moves to collect liquidity. This is why we see sudden spikes, fake breakouts, sharp reversals. This is called price manipulation. And to trade this market is to understand manipulation. Can we see liquidity directly? Here's the important part. We do not have access to central bank data. We cannot see where the real orders are sitting. We predict where liquidity is likely to be. We identify high probability liquidity areas, low probability liquidity areas. This is skill, not guessing. Liquidity controls market tops and bottoms. Every major high, every major low is created because of liquidity. Price goes up to collect buy-side liquidity. Price goes down to collect sell-side liquidity. Liquidity decides where price stops and where price reverses. Time frame matters, very important. Now listen carefully. Liquidity is not the same on all time frames. The higher the time frame, the stronger the liquidity. That means weekly liquidity, daily liquidity. These are very powerful, but as we move down to smaller time frames, liquidity becomes weaker. Lower time frame liquidity is easier to break and less reliable. That's why higher time frame liquidity is not the same as lower time frame liquidity. Liquidity classification: major, medium, and minor liquidity. Now let's talk about major liquidity. This is where the biggest money sits in the market, and this is where the biggest moves are born. Where does major liquidity exist? Major liquidity is found on higher time frames, especially on previous weekly highs and lows, previous daily highs and lows, major swing highs and swing lows on the higher time frames. These areas are not random. They are magnets for price. What is actually sitting there? Here's the key idea. All of these highs and lows are not just lines on a chart. They are liquidity. That means stop losses, pending orders, big money waiting. This is where a lot of money is placed. Which liquidity is more important? Not all liquidity is equal. A swing high on a monthly or weekly chart is much more important than a swing high on a 5-minute chart. Why? Because the higher the time frame, the more money is sitting there, and more money means more fuel for price to move. What happens when price reaches major liquidity? Now listen carefully. When price reaches important liquidity, it doesn't stop there by accident. Price goes there on purpose, to take it, to grab the money. This process is called liquidity grab. Does price always reverse? Now you might ask, does price always reverse after taking liquidity? For now, ignore that question. You'll understand the full answer later. Right now, just remember this. When price takes major liquidity, especially on the monthly or weekly chart, there is enough money for a big move to happen. The trap concept. Very often, after price takes this liquidity, it reverses. And this is what we call a trap. Buyers get trapped at highs, sellers get trapped at lows. Smart money wins. Major liquidity, major move. This is the rule. Major liquidity leads to major moves. Small liquidity, small moves. Big liquidity, big moves. If you want to catch big market moves, stop focusing on small time frames only. Start paying attention to weekly highs and lows, daily highs and lows, major swing points, because that's where real liquidity lives. Now let's talk about medium liquidity. This is where most retail traders get trapped. The retail trader's view. Imagine this. You're looking at the chart. You see a clean support or resistance level. Price comes close. Then suddenly, breakout. You think, this is a beautiful breakout. You click sell or buy, feeling confident. The algorithmic trader's view. Now let's switch perspectives. The algorithmic trader sees something different. They say, aha, let's create a beautiful fake breakout. Why? Because right above or below that retail support or resistance, there are stop losses, and stop losses are liquidity. What really happens? Price breaks the level. Retail traders jump in. Stops get placed just above highs or just below lows. And then, price reverses. Hard, because the algorithm has done its job. It has taken the liquidity. This is the trap. This move is called a trap. Retail traders are trapped in bad positions. Smart money now has liquidity, position control, and price moves in the real direction. Why this is medium liquidity? These traps usually happen on 1-hour charts, 4-hour charts, not as powerful as weekly liquidity, but strong enough to move the market. This is why we call it medium liquidity. Retail support and resistance. Retail traders rely heavily on basic support, basic resistance. And that's exactly why those levels are targeted, because everyone sees them, and where everyone places stops, that's where liquidity sits. Breakouts are not always real. They're just designed to trap you. If you learn to spot these traps, you stop chasing breakouts. Let's talk about minor liquidity. This is the liquidity used after the big money has already made its decision. Why minor liquidity exists? Here's the key idea. After price grabs major or medium liquidity, the market must move. So what happens? The algorithm sets its orders, and price begins to reverse or continue in the intended direction. To do this smoothly, the market uses minor liquidity. Where is minor liquidity found? Minor liquidity lives on lower time frames, such as 30-minute, 15-minute, 5-minute, 1-minute charts. These time frames contain smaller highs and lows, and those highs and lows are also liquidity. Liquidity works in a hierarchy. Now listen carefully. Liquidity flows like this, from higher time frames to lower time frames. Monthly liquidity is stronger than weekly. Weekly is stronger than daily. Daily is stronger than hourly, and hourly is stronger than minutes. This hierarchy is very important. Inducement, the setup before the move. Minor liquidity is often used for inducement. This means price gives you a small move to make you enter early before the real move begins. Retail traders get pulled in, stops are placed, liquidity is created, and then price moves in the real direction. How traders use minor liquidity. Minor liquidity is very useful, but only for the right purpose. You can use it for entry confirmation, scalping, precision timing. For example, if your target is 10 to 20 pips a day, minor liquidity is enough. The big difference in expectations. But here's the truth. If you want big moves, if you want a lot of pips, minor liquidity alone is not enough. You must align with medium liquidity, major liquidity. Minor liquidity is the entry. Major liquidity is the direction. Final thought. Think of it like this. Major liquidity decides where price wants to go. Medium liquidity shows how traders get trapped. Minor liquidity tells you when to enter.